So as we look at Equinix versus Digital Realty, Equinix tends to have less concentration in hyperscalers. Digital Realty has more. I would say in itself is not necessarily a differentiating factor on a rating level, but Digital Realty does have higher tenant concentration as a result of being more hyperscaler focused. We are seeing both of these companies kind of benefiting from this AI demand that is primarily coming from hyperscalers.
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Harold Chen of Fitch Ratings. Harold, welcome to Cool Vector today. Thanks for being here.
Thanks, David. Thanks for having me.
So you are a ratings analyst. Your area is REITs. And there's been an interesting trend in REITs in recent years where data centers have become sort of an important asset that is now put into REIT structures. And we expect there's going to be a lot more data center REITs in the future because the population of data centers is going to expand rapidly around the world. There's probably going to be a lot more REITs to house these assets because it's a way for investors to participate in the growth of digital infrastructure around the world. So I'm fascinated to hear your approach to determining the creditworthiness of these organizations and some of the things that make the asset class unique. So Harold, why don't we just start off with a bit of a 1,000-foot view from your perspective, given that you understand and you track both, traditional real estate REITs and now this sort of newer crop of data center REITs like Equinix, like Digital Realty Trust, both of which Fitch has issued ratings for recently. From a creditworthiness perspective, what makes data centers similar to real estate, and then what makes them different from your perspective?
We rate Equinix and Digital Realty, and those are the major data center REITs that we look at. But we still look at them within the REIT framework. We're rating them out of the REIT team. So I think when we look at them, a lot of things are very similar in terms of our approach and some of the characteristics of those REITs. At a very fundamental level, right? They are operating in the business of sort of like renting space and receiving rent for those, right? So they are leasing space out to tenants, and then they are receiving sort of recurring revenues. And what sets them apart is really, as you're comparing them to, maybe more traditional real estate types like residential or office or something like that, rather than leasing, here's a building that we're leasing to one tenant or multiple tenants. They're leasing rack space. And what is involved in that is significantly higher levels of operational intensity, right? There's a lot that goes into the management of a data center, like power, cooling, things like that just aren't going to be present in some other types of real estate. That, on the other hand, also comes with certain benefits. So, for example, they may be receiving fees for their management. In addition to the operational intensity, there's also capital intensity. Just in terms of the specifications of the data centers themselves, the kind of construction and needs in terms of making sure technology remains up to date and not obsolete.
You mentioned operational intensity. Are there simply more levers that need to be pulled and things that need to be carefully monitored within data centers where if there are errors or underperformance, it kind of affects the whole thing?
Yeah, absolutely. An office building has some amount of sort of regular maintenance that needs to be done. There may be sort of like REITs that have warehouses where they have tenants that primarily cover, a meaningful amount of the maintenance. And then maybe the REIT will kind of say, the roof is having an issue. Let's, replace the roof, right? So the amount of operational intensity there is relatively low, right? There's not a lot of moving parts. Data center REITs, in comparison are a significantly different beast. You have to worry about a lot more in terms of, power delivery, cooling, interconnections, just so much more that needs to be managed compared to some of these more traditional asset types.
In a commercial office building, you typically would have a number of different companies taking up, different floors. In a data center, isn't it often the case that there's one or there's just not that many counterparties, that maybe they're large, hyperscaler type organizations like an Amazon or something that might speak for the entire lease? How do you think about that? And is that a risk? Is that customer concentration, or is that actually a good thing because the whole thing's all full and the leases go out for, decades.
Yeah, it's quite interesting. I think, especially as we're seeing this kind of like large AI wave and increase in demand, a lot of that is coming from these large hyperscalers that you mentioned, Amazon, Microsoft, Alphabet. It can be a little bit of a double-edged sword. There are obviously pros and then there's cons as well. So when we think about the pros of these hyperscalers and the potential that, they will kind of lease a large mega campus and hold on to it for a relatively long period of time, they tend to have longer lease durations. Longer leases generally means less risk. At the same time, there may be less opportunity for the data center to kind of reprice those as the lease expires, or to increase pricing over time, right? So you're kind of trading pricing power for stability. And then another thing you mentioned, the tenant concentration. So as we look at Equinix versus Digital Realty, Equinix tends to have less concentration in hyperscalers. Digital Realty has more. That I would say in itself is not necessarily a differentiating factor on a rating level, but Digital Realty does have higher tenant concentration as a result of being more hyperscaler focused. We are seeing both of these companies kind of benefiting from this AI demand that is primarily coming from hyperscalers. They are kind of doing development for large hyperscale projects using JV structures. And that's something that we have been kind of keeping an eye on. For them, it's a way to reduce risk, right? These are large investments. If they can kind of spread the risk around with multiple equity partners and also keep it non-recourse off balance sheet, it makes sense for them. If there were to be a pullback in AI demand, those projects may be harder hit.
Can you just talk about the basics of how you determine creditworthiness based on the financial characteristics of the data center company?
The overall ways that we kind of look at a company and assign a rating, whether that's triple B plus, triple B, something higher, something lower. We are fundamentally looking at the company's ability to repay their debt. When we look at that, EBITDA, cash flow, for REITs specifically, we look at REIT leverage. We define it as essentially net leverage, not including preferred stock. And then we also look at REIT fixed charge coverage, whether a company has demonstrated access to certain types of capital, unsecured bonds, types of equity, secured debt, ABS. Those are all things that we look at when we evaluate risk. What is the company's operating history? What does demand look like? Some of the strengths of the data center REITs, Equinix and Digital Realty are both investment grade. Most public REITs are investment grade. They both have, very low leverage. Historically, data centers have had less access to certain types of secured financing, such as ABS, that has been improving.
Fitch recently issued to Digital Realty Trust a triple B rating. I saw in the notes of the rating that Digital Realty Trust's global network has given it a competitive advantage and perhaps support in your ratings. Talk about why that is an advantage from Fitch's point of view.
Both Digital Realty and Equinix have diversified global footprints. Generally, we kind of see that as being able to kind of spread risk out over different geographic areas. So for us, having that diversified, wide global footprint is a plus because companies are not as impacted by potential issues in any individual area.
Fitch recently rated a bond from Equinix. It's a green bond. We know that in the world of data centers and digital infrastructure, generally, there's a huge demand for sustainable developments, sustainable energy. What can you tell us about, green bonds and the extent to which you're seeing these in data centers in particular and real estate more broadly?
When we look at ESG, it's primarily through the lens of how could ESG factors impact the rating, right? We're not really saying, this is good for the environment, therefore it should be rated higher, or this is bad for the environment, therefore it should be rated lower. But we are looking at ways in which ESG factors could, through public sentiment or something like that, affect the rating. So for example, when we look at certain healthcare REITs, they may have an ESG score of 4 for some social factors because healthcare pricing is an issue in the United States, right? So for data center REITs, we do not have any ESG scores above a 4 for environmental factors. And as we look at green bonds, I would say that we don't really kind of view them inherently any differently than non-green bonds. They may be useful if adhering to some of the green bond stipulations may allow them to get a slightly lower interest rate or something like that. When we look at power and the potential for power as a gating factor, we primarily look at transmission rather than production, delivering power rather than generating power to data centers. The other thing I would say is that a more sustainable building, whether it's a data center or otherwise, but I think especially for a data center because they are operationally intensive, can mean less cost for a company. If you are able to save money by having more efficient buildings, that's a plus.
Can you talk a bit about what you look at in the leases, in the long-term leases with the tenants of data centers? How do they differ from regular way real estate assets? What do you like to see?
Data center leases definitely tend to be relatively short, especially with more sort of like retail colocation tenants as opposed to hyperscalers. As I mentioned, they tend to have a little bit longer in terms of lease term. Retail colocation leases can be maybe only 2 or 3 years. Other asset types have long-term leases of maybe like 20, 30 years. Shorter term leases means, potential or more potential for tenants to kind of, drop out for reduction in revenue as those leases roll. That being said, that hasn't really been an issue for any of the data center REITs. Both have, very low single digit churn. Once a tenant is working with the data center, that tends to be a pretty sticky relationship. It can be costly for them to kind of move to a different data center, and especially if they're kind of integrated in the infrastructure of that existing partner. Hypothetically, the short lease term means there is potential for customer loss. It's not really something that we've seen to a large degree, but it is still a potential risk. As credit analysts, we're always focused on the downside, and we look at the potential for AI pullback. A lot of companies experimenting with AI technology. It is sort of this new thing that has a lot of potential in terms of where could it go. But not every company so far is actually successful in terms of monetizing it, right? And so if there is a future demand pullback related to AI, that could, affect some of the hyperscale developments. The AI issue is really like the 800-pound gorilla in the room, right? I think for these companies, the increase in demand has been very positive for them in terms of, their operations, their pricing, their growth. At the same time, as we're looking at downside risks, we are kind of looking at the potential for pullback in AI demand. That said, I think both of those companies have shown themselves to be pretty disciplined with relatively low leverage.
Why do data center REITs have lower levels of leverage than do other types of REITs?
At least the companies that we look at, Equinix and Digital Realty, just historically have been relatively conservative. At each range, we tend to give positive and negative leverage sensitivities that, could lead to positive or negative ratings action, right? The bands that we've set historically were tighter than some other asset types. Data centers are very specialized. They can't easily be converted into other types of assets. So if there is something that goes wrong, are they going to be able to get contingent liquidity? Over time, we've kind of softened the leverage sensitivities and said, we think that these companies can now tolerate kind of the same leverage or more leverage than other asset types at the same rating.
Excellent. Well, Harold Chen of Fitch Ratings, thank you for speaking with Cool Vector today. I hope we can ask you to come back in the future when your expertise can help us understand the digital infrastructure world better.
Awesome. Thank you so much, David.